Imagine being stuck paying off your home until your grandkids inherit it. Sounds wild, right? Well, there's a new idea floating around in 2026, a 50-year mortgage. On paper, it seems like a way to lower monthly payments. But the reality, it could be a financial trap most Americans aren't ready for. Today, we're breaking down the math, the risks, and why it's probably a bad move for your wallet. Let's be real. Buying a home in the US is harder than ever. Interest rates are higher than they've been in years. Home prices keep climbing, and many Americans feel stuck choosing between affordability and stability. That's why the 50-year mortgage is getting attention. People think, if 30 years works, why not 50? But here's the catch. The longer you stretch a loan, the less you actually pay down the principal early on, and the more you risk losing in the long run. Most homeowners don't even stay in a house for 12 years, meaning a huge chunk of their payments barely touches the actual mortgage. The history you need to know: the 30-year mortgage isn't some random number. It's been around since the 1940s. After World War II, it became a tool for families to build equity over time while keeping monthly payments manageable. Today, over 90% of homebuyers choose the 30-year mortgage. And for good reason. It's stable, widely available, and predictable. Other options exist: 15-year loans, adjustable rate mortgages, and interest-only loans, but 30-year strikes the right balance between affordability and risk too. How loan terms affect your payments. Here's the tricky part. Your monthly mortgage payment is split between interest and principal. In the early years, most of your payment goes toward interest, not building equity. Only after 20 to 25 years do you start owning a significant portion of your home. For example, $500,000 home, 6% interest, 20% down, 30-year mortgage, $2,400 month, 15-year mortgage, $3,300 month. The 15-year loan saves money on interest over time. But the monthly payments are much higher. Most buyers simply can't qualify for that. That's why 30 years became the sweet spot. 3. Why a 50-year mortgage sounds tempting, but isn't. People think, lower payments, bigger house. Yes, please, but here's the math. Stretching a 30-year mortgage to 50 years increases risk, not savings. Lenders would likely charge 7% plus interest for a 50-year loan, because they're taking on decades of uncertainty. Even if the interest rate stayed the same, which it won't, your payment only drops by about 10%, hardly worth doubling the loan term. 4. The hidden dangers: equity grows very slowly. If you sell your home after 12 years, you may have barely paid off $30,000 of principal. Market fluctuations matter. A small dip in home value could leave you underwater for decades. Banks and investors dislike the risk. 30-year mortgages work because homes typically sell every 10 to 12 years. Keeping money circulating, stretching to 50 years disrupts the system. Bottom line, a 50-year mortgage isn't just a long-term commitment, it's a financial gamble for buyers, banks, and investors alike. If your goal is affordability, there are safer, smarter ways to lower your monthly payments. Consider a 15 to 30-year mortgage with a slightly higher down payment to save on interest. Refinance strategically. If rates drop, don't assume a longer loan automatically saves you money. Cut costs elsewhere: subscriptions, dining, and yes, even your phone bill. For example, services like Helium Mobile can cut your phone bill to $0, $30 a month. Freeing up cash for your mortgage. Increase your credit score before applying. Better credit equals lower interest rates. Avoid gimmicks like ultra-long mortgages that sound good, but rarely deliver real savings. This video is for educational purposes only. I'm not a financial advisor, and your situation may vary. Always consult a professional before making major decisions. Next time, we're diving into how the U.S. housing market could actually become more affordable in 2026, without resorting to risky loans. If you want insider tips on saving thousands while buying a home, make sure you stick around for that. And if you enjoyed this deep dive into mortgage math, hit that like button and subscribe. Your future self will thank you.